Hi, everyone. I'm your host, Rob Campbell, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Jeff Moe is back on the podcast this week. I know, Jeff, you were just on a few episodes ago, so welcome back.
Thanks, Rob. Great to be back again.
Perfect. Well, our topic is a little bit different this week. We're here to talk about Mawer's U.S. mid-cap strategy. It's a relatively new one at the firm. And so before we get into the portfolio and perhaps some of the holdings, wondering if you can share for our listeners just some of the background and history around our interest in U.S. mid-cap stocks and the strategy itself.
This is a new strategy at Mawer. The mutual fund part of the strategy is launched on September 27th of this year. The strategy itself has been around as an asset class since October 2020. We kept it internal for the first year. We called it a sandbox process where we can just work through the kinks of launching an asset class as well as testing the strategy and seeing how well it would perform. But the idea, I guess, of investing in US mid-cap and smaller stocks has been around for many, many years. First and foremost, as most of our listeners know, our US equity fund is an all-cap strategy. So that fund has been around since 1988. And so we've been investing in US mid-cap, smaller cap stocks since that time. In fact, as part of the case for considering whether or not we could add value for clients with this new strategy, we actually went back and looked at the holdings, the mid-cap holdings in the US equity fund, as well as other asset classes that could buy mid-cap and small-cap US stocks like global small-cap, global equity. And we found that depending on exactly the time period in which fund, but over either 10 or 15-year time period, it seemed like that Mawer's mid-cap picks tended to beat various US indices by anywhere from kind of 5 to 7%. So that was a big catalyst, I think, for us to say, hey, we have historically created a lot of value for our clients in this asset class. It's just that we've never chosen to expose these stock picks directly to our client base in a specific strategy. And so I think that is why we chose to consider US midcap as a separate standalone strategy.
What's the benefit to client allocations in having a dedicated US midcap exposure in their portfolio? What role do you see this playing in a client's overall asset mix?
Like some of our other smaller cap size strategies, such as Global Small Cap or the New Canada Fund, which I also manage, that's a Canadian small cap strategy for those who don't know. The main attribute here is that we are looking at the companies in the US that aren't the household names. So when you talk about an Amazon, a Walmart, a Procter & Gamble, a Nike, these are the companies that define America, of course. But below these top 300 or so companies, there's a huge swath of companies that are defined as US mid-caps. The US is historically, and still today, I believe, the most entrepreneurial country in the world. And there are constantly companies rising up and perhaps creative destruction taking some down as well. And so when you think about Mawer's investment strategy, creating relatively more concentrated portfolios of wealth creating companies, so out of the 2,000 stock universe and picking 42, which is what we've done, we think that there could be a lot of value that is added for our clients, both from a perspective of absolute return, but also risk. We think that we can really balance the portfolio by being stock pickers in such a rich universe of stocks.
I would also think that just up cap, if I think about the S&P 500, I mean, that index has gotten significantly more concentrated. You mentioned Amazon, but just the FANG stocks and some of their success is another rationale for mid and smaller cap companies in the US just to offset some of that rising concentration in the more typical large cap portfolios?
It is. And this is my personal opinion. But if you look at how US investing has gone over time, more and more people have gone past it for the US. There's sort of this view nowadays amongst asset allocators that, hey, you find a good active manager for your EV exposure. Maybe you find a good active manager for, say, your global small cap exposure. And then in the US, just buy the S&P 500 because A, it's the most liquid index in the world. It's also the lowest fee index in the world. And the S&P itself is very broadly diversified. But to your point, it isn't really, because the top 5 tech stocks are over 20% of the weight of the S&P 500 now, and that continues to increase over time. So when we look at the mid-cap portfolio, this is a great way for investors to expose themselves to US and really get that, I guess, American dream exposure without needing to have a 20-25% weight in big tech stocks. That they're great companies, but at the same time, they probably all tend to trade in a block with each other. And this year, I think they've been a little bit weaker because of the antitrust issues and some of the other headwinds they're facing.
Jeff, I mean, we've been talking for a little while. A question I've had since the beginning basically is, how are we defining mid-cap? And this is maybe just a pet peeve of mine, but these terms small and mid-cap tend to get thrown around quite a bit. Everybody's got a different definition, whether it's the market cap hurdles that define these categories, or are there certain qualities of the companies that you're looking for that you're trying to invest in that distinguish them more qualitatively versus larger cap stocks? But I guess to put the question a little bit more simply, what is the universe that you're looking at? How are you defining the types of companies that you're looking for in this portfolio?
You're right, Rob. That seems to be small cap, mid cap. These terms are bandied about a lot. And when we started doing our research on this topic, we actually had the same kind of learning that you just described, which is everyone has a different definition of what mid cap is. So we initially tried to come at it with a very mathematical, analytical approach. And here are some set of numbers and so on. Certainly, we do have guidelines around market cap, but I think the second point of what you said there to us made more sense when we were trying to define the universe, kind of the qualitative characteristics of what makes a mid-cap company. We really tried to start there. And so when we think about mid-cap companies, these would be companies that are, I guess, not fully dominant or ready in their niche yet. These are companies that are certainly strong and have established competitive positions, and we can analyze their competitive advantage. But at the same time, they're not so saturated in the market that the potential for growth and change is no longer there. And so when we look across those companies, and then also just reference some of the indices that track mid-cap stocks in the US, we actually felt it's kind of in that 60 billion-ish and under. And that's not a number that we picked per se. That was actually roughly where the US Russell Midcap Index tops out at today. But it really is a very wide range. For example, the midcap index goes down to a little under 1 billion. In fact, the smallest company in Mawer's US midcap portfolio today is just around 800 million market cap.
So it sounds like the portfolio, at least the way we're defining it, is mostly mid-cap in nature, focus on these companies that have perhaps a little bit more growth, a little bit more runway ahead of them, not fully formed, while still preserving the ability to go down the capitalization spectrum where we're seeing opportunities. Is that a fair characterization?
That is. I would say that it's just a very wide canvas. We're going from below $1 billion all the way up to kind of that 60 billion mark. And that mark may continue to go up with where markets are going these days. That mark has actually increased since we first started looking at mid-caps a year and a half ago here at Mawer.
Makes a lot of sense given the year that you've been doing the sandbox. We've presumed something so far, and maybe you mentioned it earlier, but similar investment philosophy and process to what we're doing and what listeners would already know about Mawer to the extent that they've been listening to the past 100 or so podcast episodes. Is there anything different about the US mid-cap portfolio or the US itself that you and the group focused on US mid-caps is doing that you think is important to share with our listeners?
So just in case, I won't presuppose that every one of our listeners has listened to all of our 100 other podcasts. So just very quickly, same investment approach as the rest of Mawer. Mawer is a one investment philosophy organization, which is that we create broadly diversified portfolios of wealth creating companies run by excellent management teams bought at what we believe to be a discount to intrinsic value. So what I think we focus on, as all the other more portfolios focus on, is really identifying these wealth creating companies. And so a company can only create wealth if it has a sustainable competitive advantage. And so that's what we're looking for. We're going into this market, as we have in all the other markets that Mawer invests in, looking for companies with sustainable competitive advantages. And I think the slight nuance in the US, though, is Silicon Valley. When I say Silicon Valley, I should also say healthcare technology as well. And I know for our listeners, will say, no, that's not in Silicon Valley. Healthcare is kind of centered in the Boston area, or kind of that New York to Washington corridor and so on. And I acknowledge that a lot of healthcare research is not there. But what I mean is this kind of innovation in newer technologies, newer parts of the economy is not uniquely American, but it's probably most concentrated in the US compared to anywhere else in the world. And obviously that has created some giants like the FANG stocks that you referenced, Rob. But below them, there are hundreds of companies that are secular growers that are trying to or have established strong competitive advantages in all sorts of different niches. And so we actually have some of those holdings in our portfolio, whether it's a Charles River Laboratories that dominate kind of outsourced early stage research and also starting to be manufacturing for biotechs, or companies like a Roku that's really kind of making their name heard now in connected TV and the move from linear TV to connected TV and how ad dollars are going digital. So these are just kind of examples of companies that we've had to not necessarily tweak our process, but we've had to gain additional expertise in those areas. And so one of my colleagues, Justin Anderson, equity analyst on our Canadian equity strategy, he has also broadened his focus to kind of be a global tech analyst. And so Justin has worked collaboratively with the US midcap team several times. In fact, last October, we did a US midcap tech roadshow. So this was during the height of COVID. So this was a virtual roadshow, of course. But we spoke with over 40 tech companies in 2 weeks. And not only was Justin on the call, he brought in some of our colleagues on our development team who may have encountered some of these software products. We were really able to get down to how they develop. Do they have agile teams?
So you're talking about our own business technology analysts that are coming into these conversations.
Correct. Yeah. So the own guys who are developing our client portal, for example, for our clients.
Got it.
When you log into your Mawer app, they're also turning around helping us analyze if Elastic indeed has a strong competitive advantage against Splunk.
Interesting. Well, you've actually touched on a couple things where I wanted to go next was just first the team. And you mentioned Justin, but what is the team focused on US midcaps? Who's working alongside you in analyzing these securities and looking at portfolio construction?
Thanks for asking that, Rob. So first and foremost, I am the lead portfolio manager. As many of our listeners know, at Mawer, we have a leader decides with input model. What that essentially means is all the mistakes I own.
Can you describe the input a little bit more?
Absolutely. Samir Tagiev, who works with me on the Canadian small cap strategy, is one member of the US midcap team as well. And then Alex Romaines is sort of on what we call loan. So he was a global equity analyst, and our global equity strategy was looking to unchain, and it did, in fact, unchain itself. That's a separate discussion, I guess, for a different podcast. But essentially, the thought was global equity will also go out and potentially buy stocks that aren't in anybody else's portfolio. But a big portion of what they were targeting was in US midcaps. And so when we actually chose to go ahead and launch a standalone US midcap product, it seemed to make sense for Alex Romaines to kind of spend the majority of his time on US midcaps as well. So I would say those three individuals are the core team where the majority of their time is focused on this asset class. Outside of that, though, because it's the US and because, as I mentioned earlier on, there are already three unique strategies at Mawer that can invest in US midcap stocks, we do get a lot of support from the US equity team, the global equity team as well. And then it seems like US companies compete with almost every company in the world. And so I've had a chance to work with people on our EFI large cap team, people on our international equity team, people on our Canadian equity team, just one or two off kind of companies or industries where there's a US mid-cap company we're interested in that had an overlap, competitor, supplier, what have you, with a company in another portfolio.
Got it. And how have you guys approached the universe? You spoke just a moment ago about the tech roadshow that you've done. Is that kind of the approach? Do you go industry by industry and take a look at a bunch of companies? Or how have you guys, and initially looking at the asset class and on an ongoing basis, how are you looking at the universe from an idea generation perspective?
We're looking at it in the same way, I guess, that any other Mawer strategy will look at its universe. So we're always trying to find the 40 or so best companies that fit our investment philosophy in that universe. So I'll just speak to my kind of experience with US mid caps, perhaps compared to Canadian small caps. So in Canada, it's a much narrower universe. There's probably, call it 600 or so companies that we can invest in that kind of fit our market cap size, but half of them are clearly not wealth creating and would just be eliminated by the first plank of our investment philosophy. US mid caps are different. There's probably a few thousand companies that could fit for us. And even if you were to take a more stringent view on the criteria and so on, there's still probably over 1,000 companies we would seriously consider. And so because of that, in Canadian small cap, we tend to go a little bit more in depth with each of our companies because realistically, there's 200 to 300 companies that our clients would probably want us to pick from. Whereas in the US, we're looking at over 1,000 companies we realistically want to pick from. And so from the time that we started contemplating launching this strategy, which was the summer of 2020, until now, we've run 11 distinct reverse roadshows. So that's almost one a month, I guess, where we would kind of poll the team, pull out ideas, and then set up a roadshow. We call these things roadshows because historically, we've literally flown to New York or whatever and met all the companies that we could in the New York area. Obviously, in the COVID world, that actually is more beneficial because we don't have to fly anywhere and we can hit all parts of the US in one roadshow. And so we've spoken with, I'd say, well over 200 companies since the asset class launched. And this is on top of all of the conversations that our US equity team, our global small cap team, our global equity team have already had in this universe. And so in many cases, I would say these are companies that the US mid-cap team is revisiting with a new lens and perhaps just revisiting for the first time in a few years that Mawer has touched the company. And that there are some companies that we've never spoken with as a team. And so that was how we approached the universe.
All right, well, let's get a little bit more specific, I guess, in terms of bringing the portfolio to life. Can we chat through a couple of holdings in the portfolio?
Yeah, absolutely, Rob. I'm a bottom-up investor. I've just been waiting for this section of the podcast.
Awesome. Well, you mentioned one earlier, Charles River Labs, I presume is based in the Boston area.
It is.
Top holding in the portfolio. You gave us a little sense for what the company does, but why is it deserving of kind of a top 3, top 5 weight in the portfolio today?
Charles River Labs is very unique. It reminds me of that comment about the San Francisco gold rush, where you don't want to invest in gold claims, you want to invest in the picks and shovel makers. And so Charles River is very much making picks and shovels for the biotech gold rush. And 2 parts to it. One is, despite some cyclicality, if you look over the last 20, 30 years, the amount of money spent in biotechnology R&D has steadily increased above inflation. And so Charles River, what they do is they are the leading provider of preclinical contract research outsource work for large pharmaceutical companies as well as smaller biotech companies. And they actually got into that position because they were the leader in animal models way back in the day. And they still are the leader in animal models. As we probably do know, pharmaceutical research does involve testing certain compounds and drugs on animals before they're tested on humans. And so these animals need to be cared for and in some cases managed, very carefully bred and so forth for specific tests. And so that's what Charles River was 15 years ago. And then CEO Jim Foster, he had the strategy of saying, well, because animals are usually used in the early phases of trials, obviously by the time you get to a phase 3 trial, you want to be testing on humans to test for efficacy, not animals. And so they said, okay, well, we kind of have one little sliver of the early stage process. Let's get into more. And so they got into safety assessment, seeing if these potential drug compounds are safe or not. And they got into what's called discovery, So actually helping on an outsourced basis some of these biotech companies to discover new compounds that they could then see if they could find diseases to cure with. And then they got into manufacturing now. So a new area in biotech is cell and gene therapy. We know about gene therapy quite a lot because the vaccines nowadays, mRNA, are based on using the RNA and DNA of the body itself to create therapeutic treatments. And so Charles River has really come to dominate. They're the number one player in each of these things that I mentioned, dominate early stage drug research. And early stage drug research happens to be an industry that's doing very, very well. And so when we look at this and we put it into our DCF models, we think that Charles River is still trading at a discount to intrinsic value and should have a bright future ahead of it as this theme continues.
Well, it reminds me of when we had Seeing on the podcast earlier in the spring, and she was talking about Airum's law, basically the reverse of Moore's law, which says that the cost of bringing drugs to market is getting exponentially higher as the hurdles get higher and higher. So it sounds like Charles River Labs is a beneficiary of that theme.
Absolutely. That's a great example.
Let's move on to another one. Jeff, you spent most of your time at Mawer focusing on Canadian small caps. Has that perspective been helpful when looking at US mid caps? I mean, do some of these companies compete? And if so, how has that played out in terms of a name in the US mid cap portfolio?
Oh, absolutely. It's helpful in so many different contexts. So first of all, Canadian small cap, that portfolio, at any given time, anywhere from 40 to 45% of the revenues generated by that portfolio are actually in the US. And so even though I'm relatively new to managing a US portfolio, I've been looking at the US and economies and locations and how it impacts various Canadian domiciled companies for my entire career. So that background has been very helpful, and which is probably why when we looked around the team and we said, I think it would make sense for us to have this product for our clients because we think we can add value. Then the question was, who should be leading this product? I think that's why others in the team felt maybe I was naturally positioned to do so. But to your more specific question, let me give you the example of a company that very directly related to a Canadian small cap company. So earlier this year, we participated in an IPO in Canadian small cap in a company called Magnet Forensics. Magnet is actually the second largest player in the digital forensics investigation software industry. The number one player, lo and behold, decided to do an IPO on the NASDAQ. Well, technically a de-SPAC transaction on the NASDAQ a few months later. And so given all of the work we did looking into the digital forensic investigation industry, Celebrite was the name of this company. We decided to initiate on Celebrite as well for the US mid-cap portfolio. The research that we did on the industry was completely comparable. In fact, it was kind of funny because we actually reached out to Celebrite's management team to do a scuttlebutt on our magnet forensics research. And then that obviously was very applicable when we decided to also buy Celebrite. Both of those companies are a great company because this is just continuation of the theme of finding more efficiencies and more efficacious ways of doing things as the world continues to move digital. And so as more and more crimes have either a digital component or in some cases become a completely digital crime, perhaps like child pornography, unfortunately, Celebrite are the good guys. They have the technology that can take the data on, say, an iPhone or a laptop, and they can find the history of what this user was doing, where he or she moved files, which forums they were talking on in the dark web, what did they download or upload. And so those type of things are becoming more and more critical for law enforcement. In fact, I think I read a stat saying that over 80% of all law enforcement investigations today have some type of digital component. And when they say digital component, chances are in more than a third of the cases, they're using Celebrite's technology to access that digital component, which is why Celebrite has such a great market position. They're the leading provider. They have the best technology. And this is an industry that's growing at 25, 30% a year. And Celebrite is growing even faster than that, given their leading technology position.
Apple's been in the news recently on this topic with respect to things on your iPhone and them being able to scan and see whether you've got any sort of child pornography materials and reporting those. Would Celebrite have been involved in that news item that would have come up about a month ago?
Well, I think Celebrite is actually Apple's worst enemy, because the reason Apple was in the news for that was because they built their whole brand image around
privacy
and data protection. And so there was actually a huge uproar when Apple said, hey, other than giving you privacy, we're going to take that away if we scan your phone and find certain images. Of course, I mean, Mawer is not certainly a proponent of saying we shouldn't be going after child pornographers. Absolutely not. But what we're saying is Celebrite is indeed, even before Apple went ahead and said they could perhaps do the scan, Celebrite was the guy that actually allowed law enforcement to crack the iPhone and find these files that perhaps would be in the phone. And so when I say Celebrite was Apple's worst enemy, Apple kind of prided itself on its ability to kind of keep data secure, but Celebrite, it's a bit of an arms race. Celebrite has always stayed ahead of Apple's encryption technology and so on, so that in a controlled manner, when it's a law enforcement official with the proper warrants and so on, they can utilize Celebrite's technology to get into an iPhone and build a forensic case for why a potential perpetrator is in fact guilty.
It sounds like ESG is being kind of considered throughout this with respect to privacy as you've looked at the investment case. Speaking of your Canadian small cap perspective, obviously you're working with lots of other teams. Do you have another example of where just that scuttlebutt or working with other teams at Mawer has really helped in terms of your understanding of a business in the US mid-cap portfolio?
So KLA Corporation is probably a great example of that. KLA Corporation is the world's largest provider of a specific type of equipment used to make semiconductors. They're involved in what's called semi-cap, so semiconductor capital expenditures. And specifically, they're the dominant provider of process control equipment in semiconductor manufacturing. As you know or can imagine, we are etching thinner and thinner lines on silicon wafers to make our semiconductors and chips today. And so as you get to the size where it is literally atoms or a couple of atoms width apart, your ability to control the precision of that manufacturing process decreases. Ergo, you need more and more process control equipment. And KLA is kind of 20 years down that R&D curve, maybe longer, maybe 40 years down that R&D curve. And as things get more and more complex, other competitors have sort of dropped off to the point that we estimate KLA, depending on the niche, has anywhere from 45 to maybe 60% market share of these various types of process control equipment. And so semiconductors is an area that as a firm, we have a lot of experience with. So in our international equity fund, we hold Taiwan Semiconductor Manufacturing Corporation, TSMC. We've also looked at ASML, which, like KLA, they are a dominant provider of a certain type of equipment to make semiconductors. In ASML's case, lithography. My colleague actually in Singapore, Wen, he has looked at several of these different semiconductor companies for the International Equity Fund. And so Wen was very helpful in getting us up to speed on the industry. His colleague, Peter Lampert, who heads our emerging markets funds and is a member of our International Equity Fund as well, he's kind of written a white paper to the entire team on semiconductors. Wen was also able to help us set up some scuttlebutt talks with people in the Asian semiconductor supply chain. Because as you probably know, lots of semiconductors are today manufactured in Asia. And so having a Singapore office and a colleague in Singapore was really helpful for us to better understand KLA and its prospects.
I recently listened to another podcast, the Acquired Podcast's take on TSMC. I think it's a 3-hour podcast into that specific company and its history and just the moat. And as you said, just how other competitors have dropped off. Highly recommend for those who want to do a 3-hour deep dive into a business. But interesting, certainly the learning with TSMC in that one that we've had too. And it sounds like it applies to KLA as well. Jeff, semiconductors, pretty cyclical business or a business that's got some cyclicality to it. How have you managed that in the context of the rest of the portfolio? In other words, what stocks would maybe provide some offsets to that from a risk management perspective?
As many of our longtime listeners know, we very much try to maintain what we call inherent contradictions in our portfolio, meaning if you have one company that will do well because of a certain theme, we are actually actively looking for companies that perhaps will do poorly if that economic scenario unfolds. And so I'll give you 2 examples of companies that could offset KLA if the semiconductor cycle is weak or strong, vice versa, just offset. So the first one will be FTI Consulting. They are the largest provider in the US of bankruptcy and insolvency consulting. So when a company has declared bankruptcy and has gone into a kind of a court protected process, they would often hire FTI Consulting to help manage the company, the assets, and kind of work through usually the debt issue that the company has to kind of bring it back into solvency and bring it past the court process. FTI has obviously very strong revenues when the economy is weak. 2020 was a banner year for them, for example. On the flip side, when the economy is red hot, and presumably that's when semiconductors are being sold out the most, there's a little bit less work for FTI Consulting to do. But using our philosophy, both FTI and KLA are wealth creating companies. And so in certain market environments, KLA will create a little bit more wealth, FTI a little bit less wealth. But when you blend it over a market cycle, the portfolio itself will create a stable level of wealth for our clients. Maybe another company I'll point to is Winmark. They are a company that has a large group of franchised secondhand goods and clothing stores. Plato's Closets, for example, would be one of their bigger brands. And so when the economy is bad, what Winmark has found is typically they get more visits from people going to their secondhand clothing stores. And vice versa, when the economy is good, people are doing better economically, they are fine to go
buy new clothes. Got it.
And so again, that's an example of a company that's a little bit more anti-cyclical.
Interesting. Jeff, I got to ask you, the third element of the investment philosophy, the buying at a discount to intrinsic value, the US mid-cap space just seems to be, compared to other sort of universes or indices, equity asset classes, among the most expensive globally, if not the most expensive, if you look at it on a, say, a traditional price to earnings basis. Is this a concern that you share? And I guess, can you connect that to why US mid-caps deserve a place in a client's portfolio?
Absolutely. When we look at the same metrics that you do, our clients do as well. And absolutely, the US stocks, and especially in the mid-cap part of the universe, are quite expensive on traditional metrics when compared to their historical kind of PE ratios and so forth. I would say the offset, though, in our minds is, yes, we are worried about valuation, but there's kind of two offsetting factors. One is by having a very concentrated portfolio, we can kind of dodge and weave. We're not buying the index here. And so we think we've picked our spots within this market. The second piece that I'd highlight is the US mid-cap index is also one of the higher growth indices across the world.
This is the Silicon Valley effect that you talked about earlier.
Yeah, but for example, actually, one of our top holdings is a company called XPEL, based in San Antonio, of all places, not kind of the first city people think of when they think entrepreneurship. And yet XPEL has, even in the 1 year that it's been in our portfolio, it has tripled in value because it is the dominant provider of film protection for automobiles. And that is a market that's only maybe 6% penetrated globally, depending on kind of which stats you use. And so they just have a huge growth runway and they continue to do a good job protecting their moat. But this would be the example of a company that trades on a traditional PE basis on a very high multiple, but it's competitive advantage, it's entrepreneurial management team, they are big shareholders and aligned, and their huge growth runway and their track record of execution shows that they probably deserve that multiple. In fact, when we do the work on a DCF basis, on a discounted cash flow basis, we actually think it still trades kind of in the middle of the fair value range with upside skew potential, given how much potential there is for them to continue to penetrate this market.
Jeff, many clients look at portfolios and holdings kind of in a Morningstar style box type of exercise. So capitalization and then your growth value axis. Based on your comments, is it a fair assumption that this portfolio, relative to others at Mawer, might have more elements of growth in it as a result of the universe in which it's focused?
I think that's a fair comment. I'll admit I haven't gone through with a fine-tooth comb on every single holding across every Mawer portfolio. But my sense is that because of the opportunities placed in front of us, it's sort of that growthy stalwart, I'll call it. So companies that are growing its bottom line at 10 or 15% a year, that seems to be where a lot of the companies in our portfolio has landed. because the premium that you have to pay for that growth is not very high relative to a company that's, say, only growing 3 or 4% a year. At the same time, there are a few spots we've picked in the portfolio as well where we think that the market has undervalued the growth potential. XPEL, being a great example. Celebrite, another one, where we think that companies with maybe 20% plus growth, it still deserves a place in the portfolio as well, despite its valuation on a headline basis looking a little bit more expensive.
Beyond valuation, just as you look at the portfolio and perhaps the market today, you mentioned XPEL being up 3 times. I mean, the market overall has gone up quite a bit. What other risks are you and the team looking at with or concerned about the most with respect to this portfolio? I guess thinking about the most.
I would say inflation would be the biggest risk that we are keeping an eye on in our portfolio, because it is something that just affects the portfolio so broadly. Even when I look through the portfolio and think, well, a lot of the companies we own perhaps are more service-based and not goods-based, and perhaps have a less potential for inflation to affect them. The fact that if headline inflation and core inflation, in fact, stays at the levels we've seen in the last couple of quarters, I think all companies will be affected. And so we spent a lot of time thinking about which of our companies do have that pricing power to kind of pass on their costs. And we're happy to say that when we kind of do that analysis, we think most of our companies do have that ability, because we really have chosen companies with very strong competitive advantages, which would allow them to pass on their prices to their customers.
Yeah, I can appreciate how inflation's a concern. I think for most more asset classes would be thinking about inflation and the ability of companies to pass them through as well. I've certainly heard that from other teams too. Jeff, in terms of, you've been running this for a year, has the portfolio behaved the way that you would have expected it to through the market environment that we've had?
To be honest, it's behaved or done a lot better than we expected it to. So if you think about when we launched this portfolio, this would have been October 22nd was when we went live with the sandbox last year. And then some people might remember that in early November, right before the US election, the first vaccine was approved. I think it was the Pfizer-BioNTech vaccine by the FDA for emergency use authorization. And so that news really kind of caused the equity markets to take off. If you look at the kind of equity market charts, there was that initial recovery from the March lows into kind of May and June. And then markets were kind of flattish from June until October. And then as soon as the markets took off, what really did really well were those companies that investors were maybe most worried about through the summer of last year. So these would be highly indebted companies, companies with a high beta to the market, economically sensitive companies like construction and heavy equipment, industrials, commodities as well. Often these are companies that haven't maybe made its way into the Mawer portfolios as a whole as much as the index, because we tend not to be able to find competitively advantaged companies in those parts of the market. And that was true for US midcap as well. And so people probably remember that from, call it early November until probably kind of the end of Q2 of this year, almost every Mawer portfolio was behind its respective index. And that, to a certain extent, was true for US midcap as well, but it was always behind, I guess, by a lot less than maybe we would have expected or what we saw with our other portfolios. And then since Q2, when the markets become more choppy again, it's been more of a stock pickers market. This portfolio has actually performed much better than the Russell Midcap Index. Overall, we felt that it did better in both parts of the market that it's been exposed to in this year. So in a time that Mawer tends to do well, it's done well. And in a time when the Mawer strategies were expected to do perhaps less well, it also did slightly less well than its index, but maybe less so than we would have expected. So overall, we're quite pleased with the results of the sandbox.
Okay, so behavior largely in line with expectations, perhaps with some positive surprises, but a successful sandbox experience, hence why we're here today. And Jeff, looking forward to putting you into the rotation for the Play the Plan episodes for US Midcap going forward. Well, thanks for coming on the pod, Jeff.
Thanks for having me, Rob. Talk next time.
Hi, everyone. Rob here again. To subscribe to the Art of Boring podcast, go to mawer.com. That's mawer.com/podcast, or wherever you download your podcasts.
If you enjoyed this episode, please leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.